What's up, guys? Eric here, Mr. Fired Up Wealth, bringing you real talk today. I'm just completely unedited, just unscripted. Just going to talk to the camera, talk to the mic for as long as I need to get everything out. A lot of people like these a lot. In fact, the Discord community, Patreon Discord, it's one of their favorites. You know, we did a survey at the end of the year and this was rated really high. So we have a tier actually that's a podcast just for this. Obviously, this is a video. Usually the podcast is just audio, but I like to go on tangents sometimes and just get everything off my chest. And a lot of people like it. It helps them kind of relate to the market. And it's just real talk. It's not BS. It's not, some hype stuff that you see on YouTube. And, this channel, for the most part, we don't do the clickbaiting and the hype and stuff like that. But anyways, real talk, guys. So the market right now, I've been investing over 20 years. And what you'll find is that when everybody thinks something's going to happen, it usually doesn't happen. So I think a lot of people assume that the selling was kind of done towards the end of 2021, maybe tax loss harvesting, things like that. And that 2022, a lot of people thought we would just rocket higher. A lot of people expected a sell-off later in the year or maybe spring. And I was probably in that camp too. But at the same time, nothing really surprises me. And the thing I always tell the community is you have to remember that you're playing a completely different game. Institutional investors are essentially swing traders. They're worried about 6 months and 12 months. They're not really thinking about 6 years. They're thinking about 6 months. A lot of people that do it for a living, that are institutional investors, that are financial professionals, they get paid by annual performance. So they're in and out of stocks within a given year. And so you have to look at the macroeconomic backdrop and say, what is 2022 going to support? And you almost have a playbook. If you're an institutional investor, you have a playbook and you pull it out of your drawer and say, oh, well, this is in fashion. This is what's in the Wall Street fashion show. So we're going to buy this. And unfortunately, that actually is the case, whether it's growth stocks or value stocks. So that makes growth stocks go even higher than maybe they should, because the playbook says it's game on for growth stocks, buy growth stocks really at any price. And it just drives them higher and higher. Now you see the same thing with value stocks. You see, some names are still truly value stocks, but you look at like a McDonald's trading at a 28 P ratio. I have nothing against McDonald's, but does the growth support that type of price to earnings ratio? I could argue probably not. That thing's going to probably get slaughtered later when it's not in fashion, And right now it's that reopen trade. It's that trade, that pivot from growth to value. And it's going to be overdone both ways. So you're going to see growth stocks being sold maybe more than they should. You're going to see value stocks go higher. Just like during the pandemic, we saw a lot of the growth stocks go higher and higher every day. We never complain as investors when our stocks are up 5 and 10% every day. But when they go the other direction, we complain. You look at something like a Cloudflare. We bought that Discord, $35 or so average. Thing went up to $230. People were buying it at $200, $230. And now it's come back to, 110, 120, whatever it's trading at today. I haven't opened my portfolio this year, guys. I have limit orders on a couple stocks and I've got watch lists. I'm watching the watch list. So I know what some of the prices are doing, but I haven't opened up my portfolio to look at every single stock. What I have is what I have, and most of it I've owned for a long time, and I'm going to continue to hold it for a long time. I've had people ask me, hey, Eric, I saw on Kramer, he said, sell your growth stocks and buy value. If that's what you want to do, that's totally fine. And that might help you perform for a year. But if I've had my stock, a lot of my stocks I've had for many years, I'm not going to sell them, pay taxes, and then buy them back when they're back in fashion. And any of the stocks that I've bought recently, like the new IPOs and things like that, I'm holding those for 6 years, not 6 months. And honestly, if they go to the right price, I'll just buy more. So if 2022 is a year of accumulation where I can just accumulate shares and my stocks trade sideways for a year, so be it. I'm still up almost, I think, 300% from the March 2020 lows in my portfolio. So at some point, the music's going to stop, and we have to expect that and just be okay with it. You build wealth. As an investor, you're going to build wealth, especially if you're young and you have time on your side. You don't build wealth when you're in a bull market where it's going up every day. You're going to make your money buying stuff that's beat down when it's not in fashion, when everybody thinks it's going to go worse and worse and lower and lower. March 2020 is a great example. If you bought in March 2020, anything you bought probably did pretty well for the most part. Some of it did really well, and now it's came back down. Look at like Teladoc, it's trading lower now than pre-pandemic, and some of the stuff doesn't make any sense, and some of it does. And there's just a lot of undercurrents. You think of, let's put all work from home stocks in one bucket. So let's put, Peloton in the same bucket as Zoom, in the same bucket as CrowdStrike, and so on. And it doesn't make sense. Etsy is not the same as CrowdStrike. CrowdStrike's not the same as Zoom. Zoom's not the same as Peloton. Peloton's not the same as Roku. They're all different. And you can argue a lot of these companies are going to do well longer term. The problem you have is they get tied to the pandemic. They have accelerated growth, and they had crazy numbers that made the stocks go really high. So what happens again is people buy and overshoot on the upside, and then they sell and overshoot to the downside. FOMO and then full. FOMO, fear of missing out, makes it go higher and higher. Full, fear of losing everything. Oh my God, it's going to go to zero. And you get this push-pull, with some of those stocks. And what you got to remember at the end of the day is that some of these stocks, actually, it's like dumping fuel on the fire, and it pulled through maybe 5 years of efforts into say 1 year. And I did edit right there because I lost my voice for a second. But it pulled 5 years of growth, or maybe 3 years of growth, or whatever, into a year. It accelerated that. Now, what happens though is now you have earnings, you've got comps. So Wall Street is always going to use comparables, comps to the previous quarter. You think when you hear, it had 40% growth this quarter, that's talking about year-over-year growth from this quarter and this year to the previous year quarter, year-over-year growth. That's generally what you're talking about when you talk about, it grew this much on this earnings call. And so the problem is if Zoom grows 200 and whatever percent in one quarter, its comp is really difficult because it's comparing from that 200% the next time it reports that same quarter a year later. And, I think the recent quarter, they had 30% plus growth off of like a 200% plus comp. Well, that's really amazing growth, but Wall Street doesn't care. Wall Street only cares about the year-over-year growth. And so a lot of these stocks are going to need time. They might need several quarters to get those comps basically adjusted back. But even then, you got to remember there's pull through. You also have, of course, the fears with inflation and interest rates. And what happens is we basically try to devalue stocks. So when the environment was attractive and it was in the Wall Street fashion show for growth stocks, we paid more premium, and institutions paid more premium for that future growth. Now we're basically going to discount that. And so a lot of these stocks want to go back pre-pandemic, and you think, does that really make any sense? And a lot of stocks, you look at it and it probably doesn't make sense, but the market doesn't always have to be rational, and every stock could always go lower. So when you look at this, you got the value to growth. I got a couple notes here. The Wall Street fashion show, which I mentioned, semiconductors, I said that they were the new oil last August and that they were going to have a nice secular bull run, and they're still in fashion. They're called value tech or value growth is what they're referring to them now. I mean, NVIDIA is a 56 forward P ratio, which, isn't cheap by a value investor standard, but from a growth investor, I look at it, it's like, that's pretty attractive when you look at all the different things they have going for them over the next decade. And I like that kind of stock. It's my second largest, it might be my first largest. I haven't looked at my portfolio. It was my first, my number one holding, then my number two, but it's either one or two in my portfolio. Amazon and NVIDIA, they're always back and forth depending on the market swings. And they're both about 5% of my overall portfolio. And then I have QQQ, and I've got a lot of quality names in there. I've got Apples and the Microsofts and so on that kind of make that core. And if you're new to the channel, you haven't been here before, subscribe, go take a look around. I've got some growth videos, how to build a growth portfolio. And I teach, having ETFs as a core, DGIF, that's dividend growth investing for FIRE. Those are growth type of stocks that have dividends, like smaller dividends. So you think of like a Nike or a Tractor Supply Company, things like that. Even John Deere would kind of fit into that category, and that's in fashion right now. And then you got your growth. Maybe you put 40% in growth. You got spec, maybe 5 to 10%. But with spec, you're managing it. If you have a $100,000 portfolio, you might have $10,000 in spec and have 10 stocks, $1,000 each, and hedge that risk. And then you always have cash to take advantage of opportunities. So check out the channel, definitely subscribe and check it out. But, again, I'm thinking about 6 years, and I'm playing a different game than most institutions and even most retail investors. Most retail investors, most institutions are really just traders that are swing traders. And there's nothing wrong with that. So if anything, if that's what you're looking for, know that a lot of these growth names are going to have volatility this year. And if you're a trader, you're probably, if you're looking at swing trades and things, you're probably going after, General Motors and Ford and Nucor and those kind of names. Those are the kind of names that big money is throwing money at, and they're going to go higher probably until they don't. And then something else will be in fashion, and the fashion show just, constantly rotates new names. And just like fashion, what looks cool or what's cool to wear one year is not the next year. And I'm the last person in the world that you want to ask for fashion advice. I think I still have a lot of clothes like from college. I'm pretty simple when it comes to that kind of stuff. Anyway, you don't care. So earnings and low multiples are in fashion. High growth, high multiples are not, of course. Rotation of value to growth. And then dramatic pivot, why? If you make the pivot to value, so I'm asking why? Why are we so aggressive with this pivot? Because if you make that pivot to value from growth, like Kramer saying, sell all your growth stock. Someone asked me, hey, Eric, Kramer said, sell all your growth stock. Should we just sell our, do whatever you want. But I'm thinking about 2030, and I have companies that I know are going to be secular growth type companies that are going to be in high demand. And I'm not going to be right on every stock. But overall, I know that my portfolio is going to be worth a lot more in 5 and 10 years, even if there's short-term gyrations and if the stocks trade sideways for a year and I accumulate shares. I have no problem with accumulating high-quality stocks, and shares of stocks and companies that I want to own and build my portfolio out. I'm still up almost 300% from the March 2020 lows. So at some point, the music's got to stop, and if my portfolio has to take a year and pause so I can position myself better for the future, that's a good thing. You make your money, guys. You make your wealth, not from being in, a bull market that goes up every day. You're going to make your money buying stuff when there's blood in the streets, going against the grain, buying stuff that's not in fashion that will be in fashion later. That's the key to really long-term sustainable wealth. I mean, that's what's worked for me. I've been doing this for over 20 years. So if you make that pivot from growth to value, you better believe in the future growth of the companies you're buying. And that's the problem I have, is that some of these businesses have pretty stagnant growth. It's just they're popular. And the growth stocks that are getting trashed and sold off, they can grow into their valuations pretty quickly. So maybe, like I said, maybe it takes a year or whatever to catch up. I've said this for a while, that some of these names that ran really hard, like the Cloudflares, that they would come back and that they could trade, lower or sideways for a year, sometimes longer before they catch up. And some of the best growth stocks that I've owned in my 20 years of investing have done exactly that. They run hard. They might sit there for a while. And this is where people then, the stock pops up, it trades sideways for a while. Look at Amazon right now, great example. People give up on it because it trades sideways for a year or maybe even 2. And then they sell it, and all of a sudden it does that multiple run, and then everybody chases into it and pops the stock even higher. So the key is really to find stocks, if you're going to buy something new, before it makes that pop. And I think Amazon is a good setup for that. And I've got a video on the channel, covers my top 12 stock ideas for 2022. Some of them, are definitely not in fashion now. I think they'll be in fashion later at the end of the year. So I'm looking at those thinking that they're positioned well so that 365 days from now, they'll be, that basket of stocks should perform okay and beat the market. 1 or 2 of them might not be winners, but if you buy the overall group, you're going to, outperform. That's kind of the idea behind it. And you're not going to be right every time. Peter Lynch, of course, he's not buying hyper growth stocks and things like that. But, Peter Lynch says if he's right 6 out of 10 times, that's a success, And so he knows that he's not going to be right every time. He has clunkers, he calls in the portfolio. You're not going to be right every time. If you try to have perfection and think as an investor, you're going to pick every stock perfectly at the bottom and it's just going to go higher from there, just get out of investing because it's never going to happen. Find somebody to invest your money, buy some ETFs, go buy the VU ETF, Netflix and chill is what I always say. But if you have improper expectations, you're going to have a lot of pain and frustration in the market, so don't do that to yourself. Here's the thing. Inflation hurts deep value names more than growth companies. Because if inflation is 7%, if my stock, if my company has growth that's less than that, I'm losing money and the multiple is high. So it doesn't really make a whole lot of sense to chase some of these names. Some of them will go a lot higher. It's kind of like saying, hey, Cloudflare is a great stock. I liked it at 35. But people making the bull thesis at $220 saying, you know, it ran hard from 35 to 220, but you know what? I still really like this stock and I think it has room to run. Well, it depends on the time period. It probably does have a lot of room to run if you're talking 5 or 10 years, but in the short term, it's gonna take a long time probably before it gets back to its all-time highs. It's gonna trade lower and sideways, like I said earlier, until it kind of catches up with its valuation. The good news is that growth stocks have the ability to grow into their valuation. If you're a stagnant company, if you're an insurance type company, or you know some type of old school bank, things like that, it's much harder for you to grow into your valuation. You know, banks are going to do well as interest rates go higher and things like that, but you get my gist, right? If I'm a 100-year-old company with slow growth and I'm just a dividend payer and I don't really have any organic growth year over year or quarter to quarter, it's really hard for me to catch up when inflation's at 7%. If I'm an upstart and I have 100% growth every quarter, I can catch up to my valuation a lot quicker than some of those old school value names, those dinosaurs. Not only that, some of those stocks are going to be, those companies are going to be obsolete because they're getting disrupted. Just like Cathie Wood says, the thing is though, you got to remember again, you're trying to play a game that you're not really trying to play. In other words, if you're trying to be a long-term investor and you really believe that you want to hold something for 5 or 10 years, then you shouldn't focus so much on what the institutional investors and the traders are doing, because they're only thinking about this year, 6 months from now, 12 months from now. They're not thinking about 6 years from now and 12 years from now. So if you're focused on short term to midterm, you know, you're talking about this year, then yeah, it makes a lot of sense. Those companies that are being disrupted, that are dinosaurs, those stocks will probably go higher. But where are they going to be in 5 years? Eventually, that steam's going to run out, just like everything. And those stocks are going to sell off. And, you know, sometimes you see, look at like an AT&T, go look at a stock chart of AT&T. Things trade sideways for forever. And that's what those high yield companies do. They have no growth. So they pay out anything they can at dividend to attract people to invest in them. But the actual share price doesn't go anywhere. And there's tons of stocks like that, guys. And if you're young, you're probably not an income investor. Those stocks are great for the right people. If you're trying to be a DGI or an income investor, you're trying to retire and live off passive income. But if you're 20, 30, 40 years old and you're not retiring anytime soon, well, heck, you might not need those. It's good to have a barbell and to have some of those quality dividend type stocks. That's why you have the Tractor Supply companies, the John Deere's, the Nikes, those kind of companies. You know, there's other ones too. I mean, you think of even in the semiconductor space, there's a ton of them. You know, there's Lam Research, there's AMAT, there's a ton of quality names. Not saying that you should have all names like that, but if you have all growth and spec, you're going to have a lot of volatility and it's going to frustrate you. And you're probably just going to take your ball and go home. And then in 10 years, you're going to look back and say, why did I sell this stock or this asset if I would have just held? If I would have, woulda, shoulda, coulda just held. So it's this big mind game. It's a mental game. And that's really what you have to focus on. So the 10-year treasury yield, 1.65, I believe right now. A lot of people think that'll go up to 2. Of course, that's going to impact growth stocks, as well as things like the Fed and central banks raising interest rates, which it's believed 3 or 4 of those probably this year, right? So there's a lot of macroeconomic events that you have to pay attention to. Oil's important. That's kind of a key wild card with inflation. Is growth accelerating in value names or in growth names? We kind of just covered this. So is growth accelerating in those value names, or is it accelerating in the growth names when you think of longer term? You'd probably argue that, if you're betting on 5 years from now, you might have better chances with a higher growth company than maybe a dinosaur, type company, right? But again, the fashion show doesn't care about 6 years. It cares about 6 months right now. And that's what you need to understand. And that's, if you understand that and you can train your brain, have that mental fortitude, that psychology, it makes it that much easier, because you realize that these companies are still quality companies. They're not going anywhere necessarily, but they are expensive and they're not in fashion. but give them some time and be patient. And you look back at it in a couple of years and say, well, that was a great move. The only reason I know this, guys, is because I've been exactly in your shoes before. I've been there before where I thought I was going to go, lose everything. Should I sell my portfolio? What if it goes to zero? Growth stocks aren't cool anymore. And then a year later, sometimes it ends up being, a lot less longer than you would think. You look back and say, haha. And you can look back March 2020. You can look back December 2018. There's a ton of just recent events where things just got slaughtered. And then 4 or 5 months later, you look back and you're like, oh, wow, I forgot that happened. It's just a blip on the radar. And you look at a longer chart and it's like, it didn't do anything. But in that moment, it feels like the end of the world. And if you have a lot of beta, a lot of growth stocks, of course, you're going to get hit a little bit harder. So many prices and valuations are now back to pre-pandemic levels. You think like Teladoc, and there's some other ones. So Teladoc, and there was a few other names. The pandemic dumped fuel on certain names and accelerated growth. This makes comps a challenge. We talked about that already. With that said, I think a lot of companies will start to have surprise earnings. And as we get out of those pandemic comps, you'll start to give these companies the ability to prove themselves to retail, not just to retail, to institutional investors, and to say, hey, this company is legit. Like Zoom is an enterprise software company, and we were wrong. It wasn't just a pandemic play, and it wasn't just going to get displaced by Microsoft. And you look at some of those companies and say, well, there's no moat. I hear it on CNBC all the time. There's no moat for this company, that company, and I heard somebody say the other day, there's no moat on CrowdStrike. It's like, okay, so you've got endpoint security. You can go look at a Magic Quadrant. And you've got, SentinelOne, there's Microsoft, there's a lot of names. So what do? Do you just not invest in cybersecurity then? Do you just, put it into, an ETF? I got my dog coughing in the background. I don't know if you can hear that or not. She's like 16 years old. And unfortunately, it's kind of sad. Her throat is starting to kind of cave in. She's a small dog. It's a toy fox terrier. And she's on medication and stuff. There's nothing they can really do. And she's like always kind of hacking back there. So anyways, guys, if you're new to the channel, subscribe, hit the like button, drop a comment. If you like this kind of stuff, join the private community on Patreon. We've got a podcast that's just this, Real Talk. It's normally not video. It's usually a podcast. I like the podcast better because I can really think. A lot of times when I'm thinking and I'm talking, I close my eyes and it doesn't work very well on a YouTube video when I have to try to engage in the camera and things like that. But honestly, if you're listening to this now, this video works great just to listen to in your car without watching it, because really it's a podcast with a recording. It's just an audio podcast. I've got no visuals at all. But I appreciate you guys. Subscribe, like, comment. Hope this helps. Drop me a comment below. Let's talk through it. Have a good day. Take care.